Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com. Hello and welcome to Econoday Unplugged on Tuesday, the 18th of January 2022. Terry Sheehan is on the US East Coast and I'm Jeremy Hawkins in London. Well, there seems to be a growing sense among investors that at least some central banks are falling behind the curve as already well above target inflation continues to accelerate. In many regions, pipeline pressures remain intense and zero COVID policies in parts of Asia are only adding to supply shortages and further limiting productive potential. However, it's not a one-way street for policymakers as stances are being tightened at different speeds around the globe. And in some countries, notably China, interest rates are still being cut in a bid to bolster flagging economic activity. So combined with high and rising tensions on Ukraine's border with Russia, as well as ongoing COVID uncertainty, this desynchronisation should serve to boost market volatility, and with it, potential profit available to investors in 2022. Now, one central bank for which tightening speculation seems to be gaining ground pretty well every day is, of course, the Fed. So, Terry, it seems like more and more Federal Reserve officials are favouring a rate hike as soon as March. So is March a done deal now, do you think? I guess, do you think the Fed might be worried about falling behind the curve?
I definitely think they are a lot more concerned about their response to inflation right now. We had last week the confirmation hearings for Jerome Powell for a second term as chair of the Fed and for Lael Brainerd as the next vice chair. And they got a lot of questions about inflation, not surprisingly. But they did sound a very hawkish note in regard to the Fed's response and that the Fed was paying close attention to the numbers.
Okay, how many interest rate hikes this year?
I think almost certainly 3. There's been talk as many as 4 or 5.
As many as 5. I heard of 4. I haven't come across 5. Right. Okay.
Well, that's on the more extreme end, of course.
Yep.
But a lot of it's going to depend on the path of the U.S. economy and the path of the pandemic, as it has for, nearly 2 years now. Certainly, even the more moderate and some of the more dovish policymakers are talking about a rate hike as early as March, which means that they're very likely to do a swift and sharp winding down of their asset purchases, starting that they should announce at their January meeting next week. Both Powell and Brainerd have said that asset purchases should end before rate hikes start. If we're talking a March rate hike, then it's going to be necessary to get that program closed quickly.
Yeah, right. Okay. All right, let's assume then for what you're saying, if they're getting increasingly concerned that, none of this transitory business on inflation anymore, it's about how far this thing's going to go up and how long it's going to stay up there. What chances would you give of perhaps around the 25 basis point hike? The initial one comes in at 50 basis points to perhaps sort of catch up with what they've missed in the past.
I don't think so. I think a 50 basis point increase would be pretty extreme. We're seeing some signs of a slowing in the upward price pressures in some respects. So I think that after their last experience of raising rates and then having to roll back those increases, it is going to be an incremental process, unless there is something out there that really alarms them.
All right, let's try playing devil's advocate then. Looking at some of the latest numbers on the real side anyway, you had some disappointingly weak retail sales for December. Industrial production was down in December. University of Michigan, the sentiment numbers were down there. Econoday's economic consensus divergence index is currently running at minus 35, so quite well into negative surprise territory. What chance then do you think, given a whole focus about how quickly the Fed's going to tighten, that the fourth quarter comes in surprisingly weak, and all of a sudden this this big push towards higher interest rates starts to fade away a little bit?
Well, one of the things that we've seen in the last week is that two of the Federal Reserve District Bank GDP nowcasts, which are very early forecasts of growth for the fourth quarter, were revised down substantially from running around an average of about 6% down to an average around 4%. That's a pretty abrupt change after that took place after the retail sales report. And I think this is why the Fed is going to have to be careful about raising rates, is we may be moving back to an economy that's growing somewhere around 2-3% over the longer run. And therefore, swift rate hikes would be damaging to that. The other thing to think about is that whatever GDP growth is, the Federal Reserve is going to set their monetary policy based on price stability and maximum employment. Right now, in spite of the consumer spending numbers, in spite of low consumer confidence, the U.S. economy is moving rapidly toward maximum employment. Therefore, it should be able to support these higher interest rates. The other thing is to have price stability. There was a lot of talk last week about how the Federal Reserve monetary policy addresses demand side, not supply side forces driving inflation. But to control inflation on the demand side, you raise rates. So I do think a certain amount of rate hikes are baked in the cake. As to the timing of them, we're going to have to see how the economy starts to look in the first quarter.
Okay, I noticed something last week saw that 5-year inflation expectations moving up. Was it 3.1 versus 2.9, if I remember? How much weight does the Fed attach to these expectations of inflation built into the market, or indeed from the various surveys?
Well, they certainly pay more attention to the longer term ones, like the University of Michigan has a 1 year and a 5 year. The 1 year can jump quite a bit based on short-term things, like usually it's energy prices that are driving that one. They certainly pay attention to it, but as long as the expectations don't look like they're coming unanchored, if we saw these 1, 2, 3/10 increases consistently over a few months, then the Fed would be more concerned. Right now, they seem to be running in a range, and yes, they're higher than they were, but they don't seem to have run out of control yet.
Okay, one last thing from me in terms of the numbers. Just a short while ago, we had the New York Fed Empire State Manufacturing Index, which was well below what the market was anticipating. Is that something we should pay a lot of attention to it, or just one of these yet another surveys which perhaps adds a little bit of jigsaw to the puzzle but doesn't really say that much?
I wouldn't say don't pay attention to it, because it's a pretty dramatic decrease. But that headline is a measure of sentiment, not calculated from movements in the components, as some are.
Mhm.
It can be quite volatile. And if you do an equivalent index on the details compared to the ISM manufacturing index, the decline isn't quite that severe. The other thing I would suggest looking at is that its 6 months expectation index, while down, was only down a point or so. So, over the longer run, they're still looking at this modest to moderate pace of expansion. So, yeah, you need to keep an eye on it, but it is one region in the US, 1 month's data.
Right. As ever, monthly data. Remember from the days at the Bank of England, and never looked at anything shorter than 3 months. 1 month would be a definite no-no. Markets so different. Okay, anything else from your side, Terry?
No, we're in what they call the communications blackout period around the FOMC meeting. So we're not going to be hearing anything else from Fed policymakers on monetary policy until the day after the meeting. But I would say that I looked back at the comments from those who will be voting at the next meeting, and they were definitely leaning hawkish. So I think expectations for a reasonably big move in terms of removing stimulus are pretty strong.
Yeah, okay. Certainly the way bond markets are trading at the moment, very much consistent with that. Okay, thanks for that, Terry. Excellent as always. Well, then, what have we got? Well, already on the tightening path, of course, is the Bank of England, and this week's data could well determine whether or not rates go up again here in February. They hiked back in December, of course, back into last year, and certainly the market speculation is that we'll probably see another 15 basis points, perhaps even more than that, when we get into the next meeting on the 3rd of February. Supporting that, well, last week we had November GDP, the monthly output numbers we get from the UK now. That was surprisingly strong at 0.9%. That was more than double the market expectation, and perhaps psychologically important, if not actually that much to do with policy. But it does mean that the economy is now 0.7% above its pre-pandemic level back in February 2020, and that's the first time we've seen total output above its pre-crisis level since the virus actually struck. So if nothing else, that makes it a little bit easier for the bank to come out and tighten if it wants to. Perhaps more importantly, we had very important labour market data today, which showed extremely solid employment growth. In fact, the December payroll number showed a record increase. There was also an unexpected drop in the jobless rate. Key's going to be wages. Here we did actually see another deceleration. I'm looking at this quickly at headline earnings growth. That's now year-on-year numbers running at 4.2%, down from 4.9%. But the problem, as we've talked about on previous podcasts, with a lot of the annual comparisons, is that they're distorted by compositional changes and the like due to COVID. But what we can do is look at some of the 2-year rates. I was quickly doing that before we started the podcast. And on basis of that, what we're actually seeing is wage growth in the UK accelerate and really accelerate quite significantly over the course of the last few months. So in terms of regular earnings, so stripping out bonus payments, if we go back to the middle of last year, that was running at 6.9%. So this is comparing a level of earnings with a level of earnings 2 years previously, just to try and take out some of the COVID impact. Well, that's increased now from, say, about 6.9% up to 7.8% as of the latest data. Now, with a 2% inflation target and UK productivity at best probably now only about 1.5% or so, it really does suggest that the wages are running at a far too rapid a rate for the Bank of England to meet its inflation objective, certainly on a sustainable basis anyway. So on the basis of what we got out of today's numbers, it does seem as if it's likely we'll see another tightening coming through once we get the MPC meeting first week of next month. Also, the inflation numbers and sales December, the CPI due out tomorrow, Wednesday. That's expected to see the headline rate, the annual rate, got to 5.2% from 5.1%. May not be quite as high as we've got Terry's side, but nonetheless, that will still constitute a 30-year high and clearly well above the 2% target the Bank of England operates with. So put it all together, it really does suggest the UK economy at the moment, notwithstanding the huge increase we had in COVID cases, has actually stood up pretty well. Of course, restrictions, new COVID restrictions in the UK have been very limited since the last big increase in Omicron. And from the latest numbers there, they have started to come off quite sharply. Remains to be seen whether or not that remains the case. But maybe the government's got that call correct, and certainly it's helped to keep the economy growing rather than initiating fresh lockdowns or new restrictions, which could have hit growth. So, as mentioned, it does look as if the UK at the moment, anyway, is holding up pretty well. What else shall I mention in terms of Europe? It's a pretty quiet time as far as Eurozone economic data is concerned. And there, of course, we do still have record cases, but also some very tentative signs that the Omicron factor may be starting to peak. Even so, there are restrictions in place, and that's going to hit growth in the fourth quarter and probably at the start of this year as well. And in terms of fourth quarter, should pick on the one of the struggling economies at the moment, and that's Germany. They issued full year growth numbers for 2021 last week. That just showed annual growth of 2.7% after a decline of 4.6% in 2020, obviously due to COVID. Now, within that, that implies a fourth quarter change in GDP of between minus 0.5% and minus 1%. So it really does underline the fact that the German economy has been hit particularly badly by notably all the supply chain disruptions we've had for so many months now, and they continue to impact the German manufacturing sector, notably the auto industry, especially hard at the moment. And it doesn't look like that's going to end anytime soon. So could well be the case that not only is fourth quarter Germany going to weigh on Eurozone GDP, but quite likely the first quarter will as well. So that's something to keep an eye on there, because clearly Germany, getting on for 30% of overall Eurozone GDP. So it does have a major say what happens to the total aggregate. Not too much then in terms of numbers out of the Eurozone this week, but in other things in terms of policy, we'll get the December minutes from the ECB. They're due out on Thursday. Probably won't say too much. I'll just flesh out a little bit about what they're planning to do in 2022. Be interesting, to see just how much they hint about what the clearly widening splits on the governing council about where policy should be headed as we go through this year. But as things currently stand anyway, notwithstanding the high numbers we've got on the inflation front, it looks as if the general view is that interest rates, as far as the ECB is concerned, will finish this year at current levels. So refi rate at 0, and the deposit rate still at minus 0.5%. The other main point of note this week, I suggest, really is the politics. We have mentioned it in a few previous podcasts, but it's worthwhile keeping an eye on what's going on in Eastern Europe, notably developments on the Ukraine-Russia border, where a variety of talks between international policymakers broke down last week, and there are very, very genuine worries coming out of Brussels now that Russia may be about to launch an invasion in Ukraine. If that is the case, then we're certainly going to see some reactions in the markets. Notably from the currency side, we'd like to see a move into the dollar and certainly a move back into the Swiss franc as well. And also, just quickly staying with politics and something which continues to be a bit of a blight for the euro, that's this ongoing standoff over rules of law between the EU and Poland and Hungary. Poland effectively now owes the best part of 50 million euros in fines to the EU. And EU executive has just come out and said that Poland has really until today to meet its obligations, or it will start to impact release of the COVID recovery funds, on the basis of which Poland stands to miss out on about 130 billion euros or so of these rescue funds from the budget, and Hungary could lose as much as 40 billion euros as well. So politics within the European Union at the moment, not the kind of steadfast and unified front that they might want at a time when we've got all these problems and tensions on the eastern borders. I'm saying that's certainly something which could well be an issue as far as Europe if conditions there continue to deteriorate. Elsewhere, Canada, Bank of Canada, again, one of the, central banks at the potential forefront of raising interest rates. Their business outlook, which came yesterday, that was pretty well strong across the board, very much highlighting increasing capacity pressures, labour shortages, expected wage and inflation increases in 2022. This was really put together before we had the Omicron, the surge at the back end of last year and early this year. But nonetheless, it really suggests that the central bank remains nicely on track for the first hike in interest rates soon. April, the preferred date in the market at the moment, but risks, if anything, it could do something before then. So that's another one to keep an eye on. Nothing out the Bank of Korea last Thursday. There was some talk about a possible hike in interest rates there, but as it is, they decided to, sorry, am I talking about, they did introduce a third hike last week, 25 basis points up to 1.25%. That's on the back of heightened price pressures. And lastly, China. As mentioned in the intro, that it's not all a case of rising interest rates. Full quarter GDP came in actually a little bit above expectations out of China. That was 4% year on year. That compared with an expectation of 3.3%, but within that, retail sales were much weaker than expected. Indeed, they hit a 14-month low. Industrial production relatively soft as well. And it looks at what growth there was largely being driven by exports. Domestic demand in China remains decidedly soft at the moment, and soft enough that the People's Bank of China decided on Sunday to lower interest rates for its one-year lending facility and its 7-day reverse repo agreement by 10 basis points. The first time we've seen a cut there for the best part of a year or so. And these cuts, if anything, were somewhat steeper than expected and may be a precursor to a reduction in their main policy rate, the loan prime rate, which could come about as early as Thursday. And indeed, from the way things are shaping up there at the moment, it looks as if additional interest rate cuts and possible further reductions in reserve requirement ratio could be in the pipelines as well. As I mentioned, it's interest rates still going in different directions in different parts of the world at the moment, which should give you plenty of profit opportunity as we go through the year. Okay, then, last but not least, I'll just quickly mention the Bank of Japan. There was no change in the yield curve control program announced yesterday at the BOJ's meeting. But hooray, hooray, there was a slightly more optimistic economic outlook, and that included revising up the inflation projection for the first time since 2014. Well, that, I guess, is the good news. The bad news is that the changes were so small that inflation is still seen well short of a 2% target over the forecast period. So for anyone expecting the BOJ to start tightening anytime soon, well, forget it. It still remains a long way down the road. Okay, that is it for me then. Last chance, Terry, anything else from your side?
Nothing from me, thanks.
Good. That's what we like to hear. All done for today then. Okay, so thanks everyone. That is it then for this week. On behalf of Terry and myself, thanks as ever for listening. We'll be back next week, and in the interim, of course, you can always keep track of the key market moving data and events in Econoday's global economic calendar. We hope to see you next time. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com.